Earlier this week, President Donald Trump declared that he would impose a 200% tariff on the business. A $124 billion company is on fire if it shifts production to Mexico, and Donald Trump recently declared an economic war against them. As the battle begins, why is John Deere shifting production to Mexico? How will farmers survive skyrocketing equipment costs? And is this the beginning of a trade war that will hit your wallet? Trump's threat of a 200% tariff on John Deere products could completely upend American farming. This isn't just politics. Jobs, food prices, and entire communities are on the line. Donald Trump has never shied away from making headlines. But during a contentious campaign rally in Pennsylvania, his target this time is John Deere, $124 billion cornerstone of American agriculture. Trump boldly threatened to impose a 200% tariff on John Deere's imports into the U.S. if the company moves forward with his plan to move the production of skid steers and compact loaders to Mexico. This announcement sent shockwaves through the political and economic landscape, not just causing a stir. The fallout started practically right away. Financial analysts began estimating the potential impact of the tariff on John Deere's earnings. A 200% tariff would make the company's goods unaffordable in the U.S. market, forcing them to either scrap their plans to relocate or risk losing a sizable percentage of their clientele. This action sends a strong message to businesses and investors everywhere. America is retaliating against outsourcing. But why did John Deere initially take such a drastic measure? John Deere's dilemma. Picture yourself torn between two unfeasible options: patriotism or profits for John Deere. The corporation has long been a representation of American ingenuity, with its green and yellow machines dotted on farms throughout the heartland. But like many other manufacturing giants, Deere is feeling the strain of, in addition to the fact that global competitors in nations with lower labor costs, such as China and Brazil, are producing agricultural equipment at a fraction of the cost in order to stay relevant in a highly competitive global market. Rising operational costs in the U.S. labor costs in the U.S. have increased recently, in part because of inflation and increased demand for skilled workers. Maintaining competitive prices while covering these costs has become an uphill battle. Management of Deere felt obliged to move some operations to Mexico, where production costs are much lower. However, this goes beyond simply reducing expenses. By getting closer to important international markets, Deere is also attempting to optimize its supply chain. The company wants to shorten shipping times and obtain an advantage in areas where there is a sharp increase in demand for agricultural equipment, but this business plan directly conflicts with Trump and his supporters' political views in the U.S. It appears to be another instance of a corporation putting foreign interests ahead of its duty to the country. Now that stability is under threat, workers are unsure about their futures, wondering whether they'll be transferred to other roles within the company or face layoffs. John Deere's announcement was met with shock and fear. But resources are limited, and some residents have started lobbying state representatives to step in and persuade John Deere to reconsider the move. This illustrates how vulnerable local economies can be when faced with global corporate decisions. But it's just the start of a much bigger issue the American manufacturing sector faces. This is where things start to get really intriguing. John Deere is not the first company to contemplate relocating overseas, and it will not be the last. John Deere's move is part of a larger trend that has been changing American manufacturing. For decades, businesses from a variety of industries have been shifting their operations to nations with lower labor costs, lower taxes, and fewer regulations. This exodus has left behind economically devastated manufacturing communities in many formerly prosperous industrial towns. Giants in industries like textiles and automotive electronics have all taken comparable actions. The reasoning is straightforward. Lower production costs translate into higher profit margins. However, these short-term gains frequently come at a long-term cost, as companies that relocate their operations abroad run the risk of losing the support of American consumers and facing political backlash. as evidenced by Trump's aggressive stance. Meanwhile, other nations, especially those in Asia and Latin America, are taking advantage of this trend, offering incentives like tax breaks and infrastructure investments to attract foreign manufacturers. For these countries, welcoming companies like John Deere boosts their economies and creates jobs. But for the US, the trend raises serious concerns about national competitiveness and economic security.